Welcome back to PubK's Annual Review webcast. We hope you are enjoying the most convenient way to hear expert briefings on the year's most important legal developments impacting government contractors. I'm Ryan Bird from BRG and the moderator of the fifth panel on costs, pricing, and accounting. My colleagues on this panel are Adrian Wingston of Nichols Lew, Andrea Wilson of BDO, and Greg Bingham of the Kinrich Group. Let's get started. Before we go through the overview, I'd like each of you to provide a little bit more background about yourself and your firms. Let's start to my far left with Greg.
Certainly, yes. So I'm Greg Bingham again. So I'm the president of the Kinrich Group. It's a business and litigation consulting firm. I'm also an adjunct professor at George Washington University, where I teach pricing and cost issues in government contracts in their Graduate School of Business. I often perform the role of expert witness on cost cases, and I also sort of what you might call counsel contractors on cost accounting and issues of that nature. That's basically my practice.
Andrea?
Hi, I'm Andrea Wilson. Thank you, Ryan, and thank you for PubK for having us here today. I am a partner at BDO in our industry specialty services practice, which focuses on government contracts and grants compliance issues. I in particular focus on compliance-related matters. That's typically after award when things get a little sticky and messy.
Thanks, Ryan. I'm Adrian Wigston from Nichols Lew, and I'm a cost price and audit advisor, as well as support for investigations with fraud matters related to cost and pricing issues. I'm a former DCA contract auditor and also spent time with the Department of Energy and Veterans Affairs Inspector General.
Great. Today's session will cover a number of major topics, including DCA audit activity, GAO oversight and guidance, with a focus on recent trends in DCA audit results, DoD IG external peer review, and common audit issues. We'll discuss monitoring of subcontracts and subrecipients, focusing on the differences between acquisition and assistance awards, as well as one case from the ASPCA relevant to this topic. We'll discuss the business system audit activity and trends we're seeing with the DCA, the DCMA, and specifically the DCMA CPSR guidebook. Recent updates to cost accounting standards, focusing on the CASB's agendas for the current year and following up on the 2017 NDAA activities outlined for the Cost Accounting Standard Board. We'll talk about contract terminations, things to consider, and a recent case that Greg was involved in. The 2019 NDAA impacts on contractors, focusing on key thresholds and incurred cost audits, and highlights from the recent Section 809 panel reports. So with that, Greg, would you walk us through some of the trends that you're currently seeing with regards to the DCA from an audit perspective?
Yes, certainly will, and I want to hear from the rest of you, of course. But so I'll be doing this in the context of some different data that shows trends over time. So what on the graphic you can see right now is cost questioned versus cost sustained over time, and you can see how it's trended from 2012 to 2017, and the vertical axis here is in billions of dollars questioned or sustained. And you can, I'll just summarize that it's about 50% each year, a little less, a little more, but about 50% over time. That hasn't changed much. You can see that 2014 was the largest recent year as far as total audit activity. Some other trend information, I'll just say that DCAA trended some time ago from auditing based on dollars examined per audit hour. So that was the metric that they like to focus on. That's not the metric that's focused on today. Starting back in the fall of 2008 in congressional testimony, it was said of the DCAA that they were obsessed with speed rather than accuracy. And so that in 2008 started a trend toward measuring things differently and kind of encouraging DCAA to move more quickly, especially in certain areas. So on the graphic you can see on the stage on the prompter right now, it's the percent of audited cost questions. So that's a different metric than was previously used. And you can see how it was 2.5% in 2017. So 2.5% of audited costs were questioned in fiscal 2017. That's how to read that. And that's the smallest amount since 2002 on this graphic. So it goes back quite some time. You'll see a large decrease from 2013 to 14, the big drop there from 9.8% down to 5.9%. And that relates to forward pricing rate audits. There was a significant decrease in forward pricing rate audits from 13 to 14, and that there tended to be a lot more question cost as a percentage in those types of audits. It's kind of interesting to think in terms of what types of audits these are. And so you might think, incurred cost submission, forward pricing rate proposals, cost accounting standards, defective pricing, terminations for convenience, claims and REAs, all that sort of thing. Well, in FY17, 82% of the dollars examined were incurred cost submission. So, vast majority, 82%. Another 18% were forward pricing rate proposals, and then the rest of everything rounded to zero. So CAS, defective pricing, terminations, REAs, all that, just basically rounded to zero. It was such a small percentage of the total. Just going on to the next slide, just some recent IG activity in that slide after that. In November 17, 2017, the DoD IG conducted a peer review of the DCAA. And I'll just focus on one sentence toward the end here, that the audit organizations can receive a rating of pass, pass with deficiencies, or fail. DCAA has received a rating of pass with deficiencies. So DCAA did pass, and as I said, with deficiencies. Part of that peer review on the next slide just gets into a little bit of statistics that I find interesting, and I'll just roll through. But they include DCAA did not obtain sufficient evidence, for 67% of the items reviewed, and I find that somewhat entertaining, if you will, because DCAA, I think that's one of the key findings that they often have of contractors. You have insufficient evidence. And there's a lot of fighting back and forth, if you will, or debate about what is sufficient evidence. Well, the IG found that the DCAA did not obtain sufficient evidence 67% of the time. There were scope restrictions, 12%, not adequately documenting the procedures performed, and 13% of the time. And not having an adequate supervisory review, 9% of the time. And then did not exercise professional judgment 6% of the time. So that's some of the data related to that. Now I was going to change subjects a little bit. Are there comments that that the other panelists have about the DCAA you want to?
So one question I have for you, Greg, or the other panelists, is when we look at this chart, we kind of see a trend starting in 2014, 2015. I guess 2015, a decrease in the question costs, and the question costs sustained. You mentioned a little bit about the decrease in the forward pricing rate audits. Do you see this trend continuing into the out years, and what should contractors expect?
Yeah, and so I'll jump in there. So I do, looking at my crystal ball, I think it will continue. I think an interesting statistic to me is I mentioned earlier that in FY17, 18% of the audited costs were forward pricing rate proposals. Going back a few years to 2013, it was 61%. So 18% later, 61% earlier. What would cause us to have more forward pricing rates? I hear in industry people complaining about the amount of time it takes to award a contract, because for each contract you have to evaluate the rates. There often is no forward pricing rate agreement in existence for the government and the contractor to agree to, so the government has to audit and establish the rates each time, and that's cumbersome, that's not efficient. But I'm not seeing trends that would reverse that, personally.
Yeah, and I think I agree with you, Greg, as well. And as we'll see when we take a look at the NDAA and some of the milestones that DCAA is facing, I think that the focus on the incurred cost audits is becoming a natural outcome of that. since back in 2011, 2012, when they launched their incurred cost team. They've been trying to get ahead of the bar with this, with the audit backlog. And the natural focus, I think, tends to be on the incurred costs. So if that continues to be their focus, I think the trend probably will continue in that same direction.
Yeah. And one kind of factoid related to that, so in November of 17, the DCA Senator McCaskill had asked DCA various information in November of last year. DCA responded, and they said at that time about 25% of the incurred cost submissions were older than 18 months. And they said they were going to eliminate, by the end of fiscal 18, they were going to eliminate the incurred cost audits that were older than 18 months. Now, I haven't heard,
Right.
if they actually accomplished that. I don't think it's been published yet, but that'll be interesting to see.
Yeah.
And I totally get the emphasis on reducing the backlog of incurred cost audits. I think that's where the emphasis should be.
Right.
Andre, we don't have a slide on this, but I didn't know if you had any updates on the actual incurred cost audit backlog and what we're seeing there. Has DCA made any progress? Maybe they haven't met their goals, but have they made progress in clearing that backlog? I know many of my clients oftentimes had outstanding rate years that were 5 to
Yeah.
10 years old, which create a lot of issues with contract closeouts and other areas from an accounting and finance perspective. What progress have they made, and what are you seeing within your clientele base?
Yeah, so we're seeing significant progress. And through, most of our clients are seeing that the audits are through 14 and 15. Before, obviously, as you noted, Ryan, that sometimes they would be 10 years old now. That's actually progress. And DCA is doing that through putting a lot of companies into the low risk category through low risk memos. These appear to be somewhat boilerplate, and that's yet to be seen. In some cases, at least in our client mix, we're seeing multiple audits being audited at the same time. The challenge that can bring is that if an auditor is seeing it in 1 year, they're pulling that forward in multiple years, and those can be harder to clear those issues.
So they're extrapolating to all years?
Yeah,
if they
so
see it in
if
1
they're
year?
seeing it, they're seeing it, and those can be harder. The other trend that we're seeing is that obviously the DCA hired a lot of auditors to get through the backlog, so those auditors can be somewhat green, and the audits can be a little bit more disorganized as we're seeing that, and therefore it's bringing more issues up to the ACO to clear. So that's kind of the trends that we're seeing right now.
One comment about the number of green auditors, and there's no data publicly available about this, but I think there are more fraud referrals that come from the DCAA. They've got this Form 2000 that they can submit, and you don't have to have supervisory review for an auditor to submit those Form 2000s.
Right.
And so sometimes you'll have there may be certain scenarios where you have a relatively junior auditor who misinterprets something they see, consider it to be fraud, and do a referral, even if there's not fraud, they just detect it or believe it to be, and so
Right.
that may be an outcome of having so many new auditors.
Yeah, and another outcome, and that may well tie into the reduced and the sustained question costs. I think we've been seeing a trend of question costs based on insufficient supporting documentation, or we were not able to audit these costs, we were not able to make a determination, so therefore these costs are unresolved, or something that's a little bit more broad in scope, and they sort of pass it on to the agreements officer, to the contracting officer, and I think we're seeing that some of those are not being sustained.
Yeah.
We'll be talking about the contracting officer determination of cost allowability, and that ability for the contracting officer to make that final determination, I think, is part of that trend that we're seeing.
Right. Do you want to go on to that slide that it's 31.201-2D? This is just this is a perennial battleground from my perspective, and it relates to what you just said. And it's the last sentence is, the contracting officer may disallow all or part of a claimed cost that is inadequately supported. And by claimed cost here, it's claim with a small c, not a legal claim, but a request for payment.
Right.
And And so we see that the DCAA often has a very rigorous, if there's 6 accounting documents that might exist, if you don't have all 6, then you haven't adequately supported it. And then we work sometimes with people in the Middle East and contingency environments where there's a lot of cash transactions or just much less documentary support, and there's issues related to that.
Right.
Any other comments on this section? Well, Adrian, this brings us to the next topic of monitoring subcontractors and recipients. It's received a lot of activity recently, a lot of attention, especially with the additional guidance that was published in the Uniform Guidance 2 CFR 200 a few years ago. I was hoping you could walk us through what you're seeing with your clients, what are some of the key differences between the regulations, and also one recent case that I think came out, was published at the ASBCA.
Absolutely. Thanks, Ryan. And again, thanks to everyone in the audience for being with us here today. As Ryan mentioned, in 2018, we have continued to see the issue of management of subcontract costs as a hot topic both for audits and investigations. And today we're going to try and look at that from the lens of both the FAR on the contracting side and for grants and agreements, which are governed by the Uniform Guidance. We're going to take a look at that case with Lockheed, where although the outcome was favorable for the contractor, I think what we're seeing is that contractors are continuing to have questions about how they should be managing their subcontracting costs, even in lieu of that case finding. We're then going to take a look at the DCA approach, how they audit subcontracts, and what contractors can be doing to prepare themselves for a smooth audit process, and then circling back to the determinations of cost allowability by the contracting officer and how that fits into the big picture. So starting on the contract side, FAR 42202 makes a statement that essentially says the prime contractor is responsible for managing its subs. And the big question and the crux of the argument in the Lockheed case that we're about to look at is, where does that management of subcontractors stop? Where's the line drawn? Does that mean we're auditing them? Does that mean that we're required to monitor their costs? What exactly do the regulations require from us? So let's take a look at the Lockheed case. It was not a case that was determined this year. This was from back actually at the end of 2016. But even though it's a couple years old now, it still is relevant for the same topic of monitoring
Sorry for the interruption.
subcontractors.
I see it still having influence, even though the contractor won, the government lost its case. I just see that in different people saying, well, doesn't the Lockheed case indicate that you have to do certain things as a prime managing subs? And I said,
Right.
No, that they lost that case. But
Right.
anyway, so I'm piling on, or I'm affirming your point.
But you're absolutely right, and that has been one of my concerns from a lot of what I've read around this case. I'm concerned, mainly for a client perspective, that there can be a tendency to misinterpret the outcome of that case, and that we're sort of shifting focus from what we are required to do for monitoring our subcontractors by just saying, okay, well, Lockheed won, therefore, the government is responsible for subcontractors. But for anyone that's not familiar with that case, I'll give a very brief synopsis. DCA questioned well over $100 million of Lockheed's subcontract costs. They were all direct costs. It wasn't questioning indirect rate, as is often common with DCA. So they questioned over $100 million of costs, and the contracting officer sustained the findings. Lockheed appealed, and the ASBCA heard the case. And what was novel about this case was the legal theory that both the auditors and the government derived, where essentially they were stating that FAR clause that we looked at for managing your subcontractors meant that Lockheed had a responsibility to audit them. What was lacking from their position, and what I think eventually led to Lockheed taking the case, was any specific details about the cost elements that were included in their award, specific violations of FAR cost principles, or anything that specifically said these subcontracting costs are unallowable. What was included in that, in the high dollar amount of the question costs, were assist audits that came from other DCA cognizant offices for major subcontractors that fell underneath Lockheed. And because of the proprietary data that can come into play in in these types of subcontracting costs, Lockheed actually didn't have visibility for what was being questioned. So when they were asked to respond to, it was around 18 million just for the assist audits. When they were asked to respond, they really weren't able to provide any response at all because they didn't know why the costs were being questioned. So essentially, the contractor was able to take the case because there was no position on which to base the government's findings, and they ended up taking the win in that. But was it really a win? And I think that's a big question to ask. What was the overall cost to the organization, both from a legal standpoint, organizational standpoint, the reputation, and how much time is invested into that entire process? So as we go into the DCA approach for auditing subs, I think we'll start to look at what we can do in order to set up for a smooth audit.
So was your question, what's the reputational impact on the government for bringing such a case?
Well, I mean, for instance, if an organization is required to disclose, while that legal case is undergoing and a decision hasn't been made, what's required of them? Are they reporting up to a parent company or an HQ level and say, hey, we have this contingent liability on our books now? There's all these things that come into play when perhaps had they been a little bit more prepared for that going in, knowing what DCA was going to look at, maybe they could have taken care of that with the auditors before it even went on.
So
to
the case would never have been filed in the first place, is
Yeah.
what your point. Okay, got it.
So back to the ASBCA ruling, they ruled in favor of Lockheed, but did they actually tell us anything about what we should be doing to monitoring our subcontracts? And that's what we'll go forward to on the next slide. The DCA approach to auditing subcontracts is complex, and it's a web of many different offices throughout the country. And before we dive too deep into that DCA vortex of subcontract audits, as I like to call it, I want to touch on one pretty basic principle that they have, and they refer to it as auditable subcontract. And in a nutshell, when they say auditable, they're referring to a flexibly priced subcontract that's under a prime award. So if I'm a prime contractor and I issue a subcontract on a cost incurred basis, on a flexibly priced basis, the CAM specifically outlines that, the contract audit manual, and it gives us a little bit of insight as to what DCA would be focusing on when they do a subcontract audit. So stepping back then to what the prime contractor is required to do, the FAR 42.7 and FAR 52.216 talks about certifying cost proposals and the allowable cost and payment clauses. And essentially what those say is that as a prime contractor, we have to certify to all of the costs that we are proposing in our incurred cost proposal, and that includes the subcontract costs. So if I'm going to certify to those costs, then what level of monitoring or management activities do I need to do in order to have assurance that what I'm presenting to the government is indeed allowable? So if primes are certifying their costs, there are three essential steps that the DCA outlines in their CAM that should take place. And the first is, in their proposal, making it very clear that flexibly priced or auditable subcontracts are included in the award. That triggers the CO to identify whether there's another DCA office involved that has cognizance over that award, whether a SIST audit is required, and essentially there are flow-down requirements that a contractor can use to either deflect that risk to the government or say, we're gonna take that risk. So it's a negotiation process between the prime and the sub. It's two businesses negotiating award. And as a prime, we can attempt to flow down requirements that we'll have access to those records, or say that the government will have access. And that was really a part of the crux of the argument in the Lockheed case. Neither of those two clauses were included in the award. So the auditors are searching for a way to audit these costs, and they're saying, well, wait a second, Lockheed didn't have access to the records. They're saying they didn't have privity and there was proprietary data. The government didn't have access either. The subcontractors weren't required to submit their incurred cost proposals, so how do we have any assurance of these costs? We're just going to question all of it. And eventually that led to this whole mess. So the propriety of subcontracting costs, of course, comes into play in terms of how those terms are negotiated. The DCA assist audits, in a nutshell, is a pretty simple example. If I'm at the DCA branch office in Seattle and I'm auditing Boeing, and they have a subcontract underneath that award to L3 Communications in San Diego. You know, those offices are communicating with each other to say, okay, I've identified a flexibly priced subcontract here. Can I get a review of what you found with L3 on your audits? So essentially, in a nutshell, that's how DCA will focus its subcontract efforts. It's typically by finding, okay, who else has already looked at these costs, and what can we find from those incurred cost audits that have taken place?
Well, I agree with that example, but what if the subcontractor, I mean, because the DCA probably has a presence in Boeing, the subcontractor's facilities, so it's easy for them. But what if the DCA doesn't have a presence there? The DCA may well say, no, that's not my job, and it's not convenient. So the prime has to audit the sub somehow.
Right, and I think in that situation, it all depends on which flow down requirements were in the contract. Was the access to records granted for the government, or was it denied by the subcontractor and placed at the prime level? Unfortunately, we don't have too much time to go into the details of the CAM today, but I think
but it would be so fun.
It would be so fun
for
another maybe after Christmas.
Right.
But if I'm a prospective contractor and I'm trying to plan for my subcontracting costs, I'm looking to the CAM to see what's outlined there and getting an idea of what they're expecting. Section 6802 provides, I think, a great insight as to what the focuses are for those subcontract audits. Let's move on just yet. So the next slide here, at a high level, touching on the contracting officer determinations of allowability. When we look at FAR 33-210 and 42-302, we can see that indeed it's the contracting officer that makes that final determination. I think we discussed in the trends, we're seeing issues where the auditors are questioning costs, they're passing it on to the contracting officers, and essentially they're making that final determination. What we've seen with some clients recently is almost a trend to try to negotiate directly with the CO before working with the auditors, and we feel that the most affordable and the best approach is always to strive for that clean audit first. Get your ducks in a row first, provide what you can, do everything you can to prevent those question costs from ever arriving on the contracting officer's table, and then that's where professionals like us can step in if that doesn't pan out.
Makes sense.
So we have a question from the attendees: is the government awarding fewer cost reimbursable contracts?
At the prime level, I imagine. I wouldn't say that they're issuing fewer. I think that there is a goal to issue more fixed price contracts from a risk standpoint. It passes the risk on to the contractor, of course, but the nature of a lot of the awards that we have, as we're seeing what the missions are at the different agencies, a lot of times they're based on services, and most contractors are not willing to bid on those awards in a fixed price basis. The risk is too high. So we are still seeing a high volume of the cost type and the flexibly priced time and materials, labor hour awards, and that's really where these issues come into a more impactful standing.
And I'll just add, within the last month, something I saw documented, and it was from the procurement policy within the DoD, and it said you cannot award a cost reimbursable contract without considering, and it listed a couple things you should consider.
Right.
And it sounded like a reiteration to me, a little bit of the FAR, but it was a policy memo coming out my impression is to encourage people to not do as much cost reimbursement contracting. But I think it's the viewers probably know. I mean, FAR 16 describes when you can enter into a cost plus contract, and it's part of it is if the scope of work cannot be well defined. If scope of work can be well defined, then you can enter into a fixed price. But if it can't be well defined, then you have to do a cost reimbursement. So you have to follow that guidance and award it on a cost reimbursement basis if it cannot be well defined.
Right. We saw that at Department of Energy as well. There was a memo similar to what you mentioned that was a shift towards deliverables-based contracting that have, even if it's a flexibly priced award, something that can be derived specifically on achievement of specific milestones. And unfortunately, a trend that we've also seen is that oftentimes the contract can be shaped in a way where the focus is on the deliverables, yet the auditors would interpret still stricter cost type documentary evidence being required to sustain the costs. And it can end up putting contractors in a tough situation. Stepping away from the FAR for a moment and moving over to the uniform guidance for our grants and agreements. In my mind, a great thing about the modified guidance that came out a couple years ago is the more clearly defined clauses for monitoring subrecipients. Unlike the FAR, where it's at a more high level that says prime contractors are responsible for managing their subs, the uniform guidance is less ambiguous and provides much more specific steps that that financial assistance recipients can take to monitor their subrecipients. The threshold is established in Subpart F for auditing requirements and sets it at $750,000. And what that states is that if you have a non-federal entity that receives more than that amount in a federal award, that either a single audit or a program-specific audit would be required at a minimum to support their costs. One of the things that we've also seen, particular to USAID, and their audit process is specialized guidance. So when we say know your agency, what we're seeing is that there are supplemental materials and guidance from each agency that oftentimes helps our recipients plan the audit process and be prepared for what they'll be expecting. For instance, USAID has the indirect cost guide for nonprofit organizations with a slew of information that helps them in formulating their rate, how to support it, and how to prepare for any of those audits if that comes to mind.
Good.
Andrea, what are you seeing in your practice with regards to subrecipient monitoring and findings that the IG or financial statement auditors are identifying during the single audits?
Yeah. So I think with the onset of the uniform guidance, and now that we're seeing especially the compliance area M, which is the subrecipient monitoring section, we're seeing that come to life now because now we're under 2 years of the uniform guidance with regard to subrecipient monitoring, because with that was much more onerous requirements, much more robust, much more clearly articulated. Now I'm seeing a lot more findings actually from both our audit side of the house. Obviously BDO has a ton of nonprofit clients that are subject to the UG and how to guide them through that process. The risk assessment that Adrian was speaking of, that's a new requirement. For each instance, you have to define whether or not an award is a contract or a subrecipient, number one, and then do a risk assessment. You know, it doesn't say this, but typically most organizations or grant recipients, it's not nonprofit versus for-profit. This is a mechanism requirement. You know, use a high, medium, low assessment, and that's a really good tool. And then what I say is babysit that assessment. You don't just put it to bed once you do it pre-award. You actually, you know, as you're monitoring throughout. But all of that was a precursor to OIG findings pre-UG. Now we're coming that to fruition. And what we saw before then was, you know, people would have these large, very material subawards. They, you know, weren't necessarily monitoring. They would get, you know, one-page expense reports, and they would have no idea whether or not the expenses were true, accurate, allowable, so on and so forth. And then I've obviously been on the other side of that in my practice. And had those costs potentially disallowed to the primes all over the world, very frankly, having done a lot of USAID work. So we're seeing the sort of the clawback as well.
Right. So from what you're saying, the clawback is now there's more specific regulation and there's more criteria from which the auditors to draw their conclusions, and therefore we almost have to be more careful.
We have to be more careful. On the front end, the requirements were always there, but they were sort of gray and we didn't know what they are. Now they're very clearly delineated, and now we have some room. Now we actually are seeing the OIG. I have numerous matters that I'm working on now that are specifically at this particular issue.
Yeah. Have they been focusing on elements of the risk assessment that I don't know if you've seen examples like this, whereby maybe one of your clients includes an item in their monitoring plan that may or may not have actually been required, But because they've got that down in writing now, the auditors are holding them to that, to, even if it's above and beyond what the regulations require. Have you
Yeah.
seen anything like that?
I have. I've seen that. I've also seen a disagreement on the mechanism, right? Choice of instrument is a big issue. So right from the bat, right when you have to document whether or not it's a contract or a subrecipient, that's been a big issue. And auditors saying that that was an incorrect assessment.
Right.
And then going back and saying, okay, we were going to do site visits every 6 months, and then we didn't do site visits. Now, what did that say
Right.
about your monitoring, and what does
Right.
that say about your costs? Because lo and behold, there ended up being bad procurement at that sub.
Right.
So
Yep.
it's been a very interesting couple of years.
Yeah,
I think it's a
sorry,
great
go ahead,
segue to the next topic of DFARS business systems. In this area, it's the 6 business systems by the DFARS. They're audited by the DCA or the DCMA. I haven't seen a lot of activity from the DCA. They've been focused on clearing the ICS backlog recently, but we have seen significant activity by the DCMA with regards to purchasing systems. And the DCMA updated their CPSR guidebook recently, their Contractor Purchasing System Review guidebook, on May 29th of this year. And there are a number of updates that we wanted to highlight for you. And one of them is about the subcontractor closeouts, about the monitoring activities from a prime perspective. Appendix 27 was added to the guidebook. It's titled Subcontractor and Vendor Closeouts. And that provides guidance to the DCMA auditor on what to look for in the documented policies and procedures at the contractor, as well as the procurement folders, and specifically requiring that the contractor have policies and procedures incorporating FAR Point 4.804-5, which are for contract closeouts. And there's 15 required actions. Do you have final indirect rates? Do you have final invoice? Have you disposed of any classified information? Have you de-obligated any excess funding, just to name a few? So we see this focus on subaward management trickling through to other business system audits, as there's a focus both on the acquisition and the assistance side as well. Other updates to the guidebook were to incorporate the updated procurement thresholds for micro purchase, simplified acquisition threshold, and the truthful cost and pricing data, formerly known as TINA threshold. Those thresholds were not updated throughout from the perspective of statistical sampling, but I think that's because many of the contracts that contractors have still have to comply with the old threshold unless they've modified their contract by reaching out to the contracting officer. Some of the other challenges and issues that we see are issues around counterfeit parts, commercial items, and Buy America. I didn't know if the three of you are seeing any other activities from the DCA with regards to any of the DFARS business systems.
Well, I'll just say, like incurred cost submissions, audits of those, I see the audit activity and timekeeping issues and things like that, but they're not the business system per se. They're just things that affect accounting or things that affect
Right.
purchasing. So my experience is similar to yours.
The next section is the cost accounting standards developments. Wanted to quickly highlight in the 2017 NDA, there were a number of duties that were required of the CASB, the Cost Accounting Standard Board, and one of them was that they meet frequently. They hadn't met for a number of years for various reasons. And also the NDA included the creation of a DoD CASB board, which is very interesting. Good news, the CASB board, the CASB has met in 2018. They've met 5 times, and they've started to address the key requirements that were outlined in the 2017 NDA. One of the key areas was conformance of CAS to generally accepted accounting principles and commercial accounting practices. I think that's a great thing. Some of the areas of focus are around CAS 404, capitalization of tangible assets, and 409, depreciation of tangible assets. CAS 404 talks about capitalization of any asset over $5,000. For many commercial companies, that's a very low capitalization threshold. If that was $25,000 or $50,000, it would still have no impact on their claimed indirect rates year over year, or very little impact year over year. They're also looking at CAS 408, compensated personal absences for paid time off. So the CAS board is actively looking to to harmonize CAS with GAAP and commercial accounting practices where it makes sense. They also talked about the DoD CAS board, and they're looking to have that repealed from the 2017 NDAA. And then their last area of focus was with regards to CAS 412 and 413 with regard to pensions. In 2011, the CASB attempted to harmonize CAS 412 and 413 with the PAA, but there were still some areas of discrepancy with regards to segment closings. And the PAA required potentially some early funding to pensions, which could create undue hardship on the contractors. So the CASB is looking back at the PAA to determine if additional harmonization should occur, and they'll be issuing some memos for public comment here in the coming months. Does anyone else have anything to add? From
Well,
a
you
CAS
said it
perspective?
already, but the CAS board met 5 times in 2018. I'd like to know when the last time they met 5 times in a year. It's been quite a number of years. I mean, I think that's a great development to see them as active as they are now.
And the next meeting is scheduled for January 24th, so we already know there's one for 19.
Yes. So I'll just talk a little bit about terminations very briefly. The most important thing I think that happened in 2018 was this ASBCA case, and it's Phoenix Data Solutions LLC, also known as Aetna Government Health Plans, ASBCA 60207. Decision was June 25, 2018. Remember that I'm not an attorney, there's no attorneys on the panel, but there are a lot of cost issues in this case. It was tried by Karen Manos. It was a win for the contractor. And just some of the cost issues that came up, pre-contract costs, the allowability of pre-contract costs was heavily debated, and the judge found it to be allowable. The proper calculation of a loss ratio under a fixed price contract was another key thing. And then adequate support. And we see this issue of when is there adequate support for the time incurred by personnel. And so there was a lot of, there was no time, the company did not have a timekeeping system prior to award of the contract when a lot of the costs were incurred. But they were able to prove up those costs, the estimated hours, through various things like meeting minutes and agendas and the like, and testimony from personnel. So that was quite important, I thought. This slide, just 31.2, in FAR 31 there's the cost principles, and there's a special cost principle just for terminations. It's the -42 cost principle, 31.205-42. And it reads, as is shown on the screen, that contract terminations generally give rise to the incurrence of costs or the need for special treatment of costs. So you can treat cost differently after a termination than you can in other instances. And this can give rise to lots of disputes. It's common for costs that are normally charged indirect to be reclassified to direct for purposes of the termination settlement proposal, and that I continue to see issues with that. And then just jumping on to like the contract termination, the commercial item terminations. So I was just talking about FAR 15 type termination. So you've got a fixed price or a cost reimbursement contract that is terminated for convenience. What about a FAR 12 commercial item contract? What about when they're terminated for convenience? And so this is a developing area. We're seeing a lot of interesting changes or interesting developments, in my opinion. And so on the screen now you can see in the third bullet and the fifth bullet kind of what is referred to as prong 1 and prong 2 of FAR 12.403D. And so what's the recovery after the termination of a commercial item contract? One is the percent complete times the price. So if you're $1 million price and you're 60% complete, 60% of $1 million is $600,000, that's the recovery. Plus, in addition to that, you get any charges the contractor can demonstrate directly resulted from the termination. You know, what does that mean? That's where I've seen contractors claim unallowable cost, claim lost profits, claim various things. So there needs to be more, I think, judicial direction on what does that mean, and I think we'll see that over time.
Adrian, what did you see in the 2019 NDA conference report that was key for contractors to consider?
I think the biggest takeaway from the NDA at this point is some things that we've been long waiting for. You mentioned some of these thresholds earlier. We have the simplified acquisition threshold was increased in prior NDAs from 150,000 to 250,000. The micro purchasing threshold, which Ryan mentioned, is up to 10,000, and the TINA threshold is up to 2 million, which also applies for requirements for certified cost and pricing data. So essentially, what we're seeing at this point is that although those increases have been approved, they are not yet codified into the FAR. And so they're being treated more at an agency by agency level. For example, GSA issuing a memo referencing those increases. And at this point, the best approach that contractors can take is by confirming that with their CO. They're not going to be able to see those thresholds outlined in the FAR yet. Other highlights that I saw from this year in 2019 were with direct hire approvals for Department of Defense to work on the audit backlog. We've been talking about the focus of incurred costs between forward pricing audits. I think that we're seeing in this NDA a continued emphasis for them to move forward towards those goals. And then also some things that are pending that we should keep an eye on are, for instance, the 2020 requirement where DCA is supposed to be able to complete their incurred costs within 1 year of receiving an adequate incurred cost submission. And to illustrate an example, if a adequate submission is submitted and it takes DCA 60 days to approve it, so essentially 2 months have gone by, at that point DCA basically has 10 months with which to finish the incurred cost audit, which, as we've seen in the past, has been challenging for them, quite frankly. So DCA has until 2020 to implement a plan to be able to meet those deadlines. So while we don't have a huge amount of cost issues from this year's NDA to present at this time, I think it's mainly a matter of keeping an eye on those updates to the FAR.
Great, thank you. Andrea, in about 2 minutes' time, I know there's a lot of information in the Section 809 panel, but in about 2 minutes, how would you summarize the key highlights for everyone?
Sure. So very briefly, so the Section 809 panel is comprised of about 18 people into 10 teams. So far, it's issued 2 reports, and a third one is due out in January. What we've seen so far is they're tackling everything from operationalizing a dynamic marketplace and streamlining commercial buying to CAS and the DFARS accounting system criteria. What they are trying to do is the reports are very detailed. They include red line changes to the FAR, and we see them highlighting substantial barriers to entry for much of the industry, which they're trying to make it much more friendly for other companies to buy into the government, and putting the CO as truly the centerpiece for DCAA, which is what it was intended to be. We've seen similar efforts to streamline the FAR in the past, so our hopes are high because a lot of what we're seeing in their recommendations so far, there were 24 recommendations and multiple sub-recommendations in the first report and another 10 in the second report. But what we're seeing so far is all good steps and much needed. So if you ever need to fall asleep, you can read about 1,200 pages of documents. I'm sure it's it is enthralling reading.
There is a table toward the back with
I know.
all the,
there is.
like the
there,
24 recommendations.
There are. They've done a fabulous job of putting a lot of summary documents together.
But the combined is about 1,200
it's
pages.
It's about 1,200 pages in total.
I had a similar experience with the NDA report.
Yeah.
I think it was 1,300.
So, just so you know.
Thank you to our panelists, Adrian Wingston, Andrea Wilson, and Greg Bingham, for so clearly covering critical issues and industry trends. We are now taking a short 10-minute break, and we hope you join us for our next panel on compliance and enforcement at 2:30.